Hello, this is Bob Steele. In this lecture, we will continue on Chapter 5. We're continuing with the purchase of merchandise. So we're going to continue with the journal entries here. We got the purchase returns and allowances. So if we were to return the merchandise, say there was a defect in the merchandise, and we then returned down, first of all, is cash affected? In this case, it's not being affected because we bought it on account. So therefore, if we bought it on account and we had not yet paid the account, then the transaction that would be affected would be the payable, kind of like the credit card debt, the accounts payable. But once again, the payable might not be as easy to think about as the merchandise, because the payable has a credit balance and we haven't been working with them as often as we do with assets that have debit balance. So it might be easier to think about the merchandise that we gave up, that we sold. We know that merchandise is an asset. We know that assets have debit balances. We know that the asset went down. How do we make something go down? We do the opposite thing to it as what it is, which in this case would be a credit. So we're going to credit the merchandise, therefore we're going to debit something. If we had paid cash for it, we would debit cash, increasing the amount of cash we would get. But if we had not yet paid for the merchandise, then we're going to debit the payable account. Why? Because accounts payable is a liability. Liabilities have a credit balance. We need to make the liability go down because we no longer owe for the merchandise because we gave it back. How do we make something go down? We do the opposite thing to it, which in this case would be a debit. So then we have purchase returns and allowances. So Z-Mart purchased 1,000 of merchandise on June 1st with the terms 2, 10, and 60. What does that mean? 2% discount / in 10 days. If you pay within 10 days, we get a 2% discount. Otherwise, we have to pay within 60 days. That's what that means. So we have 2 days later, Z-Mart returns $100 of the goods before paying the invoice. So we purchased 1,000, we returned 1,000 of it. Then when Z-Mart later pays on June 11th, it takes the 2% discount only on the 900 remaining balance. So let's take a look at the journal entries. First of all, when we first purchased the merchandise, is cash affected? No, we paid for it on account. Therefore, the account we're going to hit is accounts payable, but it might be easier to think about what we received in this case, which was the merchandise. Merchandise has a debit balance. We made it go up because we bought more of it. Therefore, we're going to debit the merchandise. We're going to have to then credit something, and what we are going to credit is the accounts payable. Does that make sense? Well, accounts payable is a liability. Liabilities have credit balances. In order to make them go up, we need to do the same thing to it. So in this case, we're going to increase the bad thing by crediting the payable. Then what happens is we return the merchandise, but only $100 of the $1,000 that we bought. Therefore, is cash affected? It's not affected in this case because we have not yet paid cash for the merchandise. We still owed the cash on it. It was in accounts payable. But it might be easier to think about the merchandise then if cash is not affected, because the merchandise is an asset, and we know that the asset is going down. We've dealt more with assets because we dealt with cash. So therefore, how do we make the merchandise go down? We do the opposite thing to it as what it is. Assets have debit balances. We're going to credit the merchandise to make it go down. Therefore, we're going to have to debit something. That debit will be the accounts payable because we bought it on account. We had not yet paid the cash. If we had paid the cash, we would debit cash for the return. Now, accounts payable has a liability, has a credit balance. We're going to make it go down because we no longer owe $100 of the $1,000 because we gave back $100 worth of the merchandise. How do we make something go down? We do the opposite thing to it, which in the case of a liability is a debit because liabilities have a credit balance. Then we pay off the rest of it, the final $900, within the discount period, and thereby getting the 2% discount because we paid within 10 days. So we're going to get the discount, but only on the 900. Now, if we think about just the accounts that will be affected, first of all, is cash affected? Yeah, that's what we paid with. We paid with cash. So even if we don't think about the dollar amount, we can think, well, cash is a debit balance. We know it's going to go down. We're going to do the opposite thing to it. We know we're going to credit cash. We might not know the dollar amount just yet, but we know that that account will be credited. What are we going to debit? Well, we didn't yet pay. We purchased the merchandise in the past. We didn't purchase it today. We're paying off the debt that we owed for the merchandise. That's represented by accounts payable. So accounts payable is what we owe. It's a liability. Liabilities have a credit balance. We're making it go down by doing the opposite thing to it, which in this case would be a debit. So we know what the debits and credits traditionally are. And then we got this discount we got to account for at this time. So if we had $900 times the 0.02, which is 2%, move the decimal over 2 places, you get 2%. That would give us this $18 of the discount. We can also calculate that a different way. We can say, well, if we had 900 and we got 2% discount, that's what we're not going to pay. We're not going to pay 2%, which means we are going to pay 100 minus 2%, or 0.98, 98%. So we could calculate how much of the cash we're going to receive, which is the, cash we're going to pay of 882. We have to take the payable off the books for 900, because that's what we put the payable on the books for. And then the discount's going to reduce the merchandise inventory. Why? Because we put the merchandise inventory at 900 on the books. But after the discount, it's only costing us 882. Therefore, we're going to reduce the merchandise inventory, which has a debit balance, by 18 to bring the original 900 we recorded it at down to the 882. We also have this concept of transportation costs and ownership transfer. So if we're going to buy something, say we're buying something like from China or something, and we have to ship the goods over to us, there's a question of, when does this transaction happen? When is the inventory ours? Who's taking care of the shipping costs? So if it's FOB shipping point and we're buying it from China, then once it gets to the boat that's going to be shipped over here, then it's ours at that point in time, and that's when it's going to be included in our inventory. If we are paying for the shipment of the inventory, which we would be at that, if that were the case, then that cost will be included in the merchandise. So we're going to include the cost of shipment if we pay for it in the merchandise. On the other hand, if it's FOB destination, then we don't record it in our books until it reaches our docks here in our port. Then we record the inventory at that time. That means that the shipment is generally, in that case, in the seller's hand, and therefore the seller will record it, and they will record the delivery as an expense, because they're recording the delivery of their inventory as an expense rather than us recording it as inventory, which would be including it in the inventory. And there's also issues on legal issues. What if, pirates took the ship in transit? Who's responsible for the goods when it is in transit? So transportation costs, so Z-Mart merchandise on terms FOB shipping point, the transportation charge is $75. So this is FOB shipping point, so therefore at the point of the shipment, not at the point of our warehouse, is when we receive the goods. Therefore, the costs of the shipment is part of the inventory to us, and the shipping costs are not going to be shipping expenses to us. They're going to be part of the inventory. So that the point is, we're debiting merchandise inventory for the shipment expenses to include that in the cost of the inventory and paying cash to do so. So if we look at the itemized costs of merchandise purchased, it would then be the cost of the merchandise, of course, less any discounts that we have on the merchandise. So any of those discounts that we got from paying within, in this example, 10 days, within the time period they give us a discount for that, we subtract that out to the cost of the inventory. And we also subtract out any returns and allowances. So if we return the goods, obviously we're going to subtract that out from our inventory, and then we're going to add costs for transport. So if we are paying for the cost of the transport of our inventory, then those costs should be included in the cost of the inventory that we have. That will give us the total net cost of merchandise purchased.